Welcome back to the Dividend Diplomats YouTube channel. You got your boys, Lanny Burt, the mother effing Dividend Diplomats. We're talking to you about another consumer stock that is getting beaten down again in 2023. They're a king. They've increased that dividend for 50 years, down 12% year to date. Let's go. Let's analyze a dividend stock.
Guys, before we do, smash that subscribe button. Give us a nice thumbs up. We are on the road to that 18,000 subscribers. Time of this video, we're about 90 or so away. So you better help us get to the 1-800-0. Let's go. Make some noise, X-Pac style. Dividend King on today's video, guys. Again, because what we like to do is show you possibly undervalued dividend stocks, undervalued dividend aristocrats, undervalued dividend kings to possibly buy for your stock portfolio.
Let's go, because you flock to quality when times are tough, because those dividend kings that have increased their dividend for 50 years have shown that they can continue growing their dividend through good times and bad. They've done it before. This stock is in the consumer staples sector. We've talked in the past about a lot of REITs. They're beaten down right now. But what I'm finding here, and what Lanny's seeing too, is come October, is the consumer continues to face pressure. Inflation continues to remain high. The consumer staple sector is continuing to show some value. That's the stock that are just continuing to beat down. Look at our latest video on Hormel. They got crushed. Whatever the consumer, where the budget's tightening, in their minds, those stocks are getting hammered right now.
Getting hammered, and no, it's not off of Natty Daddies, guys. They are getting hammered. Obviously you got twofold, things happening right now. Inflation and costs are rising, and that also applies to companies in and of itself. Think wage increases. Maybe there's a union involved, all those labor union strikes that are happening right now. And then on top of that, guys, you've got, the concerns from the consumer. How much can they keep spending? So how can these companies continue to grow when consumers are watching their spend, possibly buying more generics? But Bert, there's a dividend king here that you brought to the table. You brought here on this video because you're like, hey, when times are tough, never fret to look at the consumer staple.
That's right. Well, so we're going to look at Kimberly-Clark, ticker symbol KMB. Yes, they've increased their dividend for 50 plus consecutive years. Let's go through some of their brands here. Scott, Cottonelle, Viva, Huggies, Pull-Ups, all of the great things. Laney and I are both big in the toddler phase right now. You see their products everywhere. That's the beauty of it. You're hunting them down. Did I miss any of the big brands here, Lanny? I'm trying to think.
I think you dropped, obviously inside of restroom stalls, you see a lot of Kimberly-Clark, literally
Yeah,
named,
that's
dispensers on your paper towel and maybe toilet paper dispensers there. So when you go to your next Browns game on Sunday, check to see what they're using. Obviously, there's a lot of feminine products, from the tampon and pad space.
Yeah. You know what? I'm gonna beat you to this joke, Lanny.
Oh,
Those
go
adult
ahead. I already know
depend
where
the
you're going.
adult depends that you're wearing, Lanny, that you have to
Yeah,
wear every day and
yeah.
every
I
night.
actually have to. I actually have to double them up every time we
Yeah.
record a video because I love dividend and growth stock so much. I just myself every single time.
That's right. I can't believe I'm pumped. We might should just end the video. I beat you to that one. You're usually pretty fast there. All right, so Kimberly-Clark, let's talk through it. We know they have great bands. We know they have a great dividend growth history. Let's look at their last sales. Then we'll look at the balance sheet, and then we'll run them through our screener. Last quarter, it's been some time. They're getting ready to report here. They had a great quarter. Profit grew. Organic sales grew 5%. Gross margin increased 300 basis points, 300 plus base, 380 basis points. That's probably the biggest shock of all, that Kimberly-Clark managed to grow their gross margin. And on top of it, they increased their outlook. They increased the amount of organic sales growth that they're expecting between 3 to 5% for the year. Total sales are going to be between 0 to 2%. And then adjusted EPS increased that range from 10 to 14%, up from 6 to 10%. It was a very positive vibes for Kimberly-Clark.
Positive vibes from Kimberly-Clark, guys, but keep in mind here, they didn't talk about, in the positivity, number of units. They're looking at sales dollars right now, guys. So it's not to say it's kind of easy, just, hey, let's increase our prices, right? So that's more than it's fair. But again, looking at the balance sheet though, right? When times get tough, when interest rates start rising, Bert and I think it's very prudent. You should always do it anyways, is to look at the balance sheet, look at the debt. You guys know as an individual or in a family, when you have a lot of debt, what that puts on your budget. So let's see how Kimberly-Clark looks right now from a balance sheet standpoint. So we'll look at the current stuff, what's currently due, which we look at the current ratio, guys, which is taking current assets over current liabilities. So assets that they can use in the year over their liabilities that are due within the year. Actually, they're less than 1x, which is what we'd like to see at 0.87 based on that earnings release. Bert, any feedback on that from Kimberly?
No, I think the other big thing is let's look at the quick ratio because that's also that strips out the inventory. So it takes current assets minus inventory divided by current liability because that can just tell you how much is it just sitting there in a warehouse that you might not necessarily be able to liquidate as quickly as you can. The quick ratio then drops to 0.55x. So what that tells me is there's a lot of inventory sitting there for Kimberly-Clark.
Yeah, a little tighter on the budget, right, guys? Debt to equity, which let us know in the comments what you guys think about debt to equity right now for Kimberly. It seems like their equity position, without doing too deep of a dive, seems a little difficult. But debt to equity is very high at 16.
Yeah.
But long-term debt is the real fun part here, guys, because they really haven't grown their long-term debt portion a lot, going from 7.6 billion to 7.9 billion. So slight increase. So the balance sheet is
Yeah. Yeah. It wasn't as optimistic or as rosy as you left feeling feel after talking about the sales. That is for sure. So now that we've seen the balance sheet, it might not be as great as Lanny and I want to see. There's a lot of debt, obviously. Let's run them through the screener. Let's run them through our metrics. And Lanny, what are the metrics that we're going to talk about today?
3 dividend stock metrics, guys. Wait, subscribe, like this video if you haven't already. But the first one we look at is the price to the earnings ratio, taking share price divided by projected earnings per share. We compare that to the competitors or to the S&P 500, which is around 24, 25x right now in the S&P 500. We then look at the dividend payout ratio, which is the safety part of the dividend. Can they continue to pay and can they continue to grow? We'd like to see less than 60% taking dividends over that projected earnings. Then we look at dividend growth. As Bert said, Kimberly-Clark is a dividend king, 50 plus years of growing dividends. So we like to look at the streak as well as the rate that they can grow the dividend because you want your passive income to grow by a nice rate that beats the rate of inflation, which is pretty tough nowadays. We'll say that. And then, Bert, we look at the dividend yield, guys, as a little cherry on the top if all other metrics check out.
That's right. So let's jump right in here. Kimberly-Clark closed as of 10/13 Friday. That's what the prices we're working on. Friday the 13th. Spooky. All right. The price is 120.41. Divide that by the earnings per share from Seeking Alpha of 6.99. That's a PE ratio of 17.23x, so below the S&P 500. And I didn't publish this, but I checked in on what is Procter & Gamble, one of their biggest competitors, price to earnings ratio. Procter & Gamble is 21x, so they're below their competitor.
Yeah, below their competitor. Typically, PG is a little higher. But Kimberly showing 17, showing some value possibly here, guys. Dividends, they've increased their dividend recently this year. Currently pay $4.72 right now per share per year. Break it down about $1.18, I think, per quarter. 67.5% payout ratio, so just above the 60% ceiling. The consumer brands typically have a higher payout ratio. Procter & Gamble is a very good example of that. They've always been in the 60 to 70% range as well.
Yeah, their 5-year dividend growth rate is 3.43%, and we've mentioned that they're a dividend king. So dividend growth has been lighter for Kimberly-Clark than you'd like to see. I mean, there's no way around that.
There ain't no way around that, brother. But guys, right now that 5-year average yield, is 3.17%. So they currently yield 3.92%. So you're getting, about what, 75 basis points higher than their 5-year yield average. So as the stock price comes down, yield goes up. Hopefully the yield going up makes up for the lower dividend growth rate. And Bert, share price down 12% this year, up 5% since October of last year. with a solid market capitalization right now of 40 billion at the moment.
All right, so let's summarize here before we give our final thoughts on Kimberly-Clark. PE ratio 17, payout 67, 5-year dividend growth rate's 3.43%. They've increased that dividend for 50 plus years, and they have a yield of 3.92%. Lanny, I don't think you own Kimberly-Clark. I don't either. So this would be a new position, I believe.
It would be a new position if we were to buy, guys. Is this a stock to buy right now? Is the question I have to ask myself. And it's just the combination of yield and growth aren't quite there yet with me. Now, if they had, obviously the last increase for the dividend was like 1.7%, going from $1.16, $1.18. So there's probably limited dividend growth maybe for the couple of years as everybody fights through inflation. So the yield would have to be higher for me to start a position in Kimberly-Clark.
I agree, and I'm just not there right now either. Not just that, but I also really don't like those debt metrics, to be completely honest with you. They have a lot of debt. Debt to equity is high. Current and quick ratio aren't exactly where I'd like to see them right now. So when times get tough, Lanny and I say we're going to keep bringing this up in our videos as we look at stocks. We're continuing to hone in on debt because those you want to see the company with less debt, so you don't have that dividend versus interest trade-off where the decisions get really tough. And look, there are other value in the consumer sector. We've talked about a lot of other great dividend stocks with better metrics that are for sale. So right now, I'm not initiating a new position on Kimberly-Clark, and I'm probably not even watching them. I'm going to keep moving along.
Keep moving along, keep investing, guys. So yeah, we're both kind of just not buying right now. The price would have to come down quite a bit more for Kimberly-Clark for both of us for it to even be on our radar just because of other valuable stocks out there. But what do you guys think? Do you own Kimberly-Clark? Is this a stock to buy, or you have other stocks to buy right now as you're building your passive income stream here, reaching that financial freedom goal?
That's right. If you haven't already, subscribe to the channel. Give this video a thumbs up. And remember, if you're not with us, you're against us, Jack.
That was Bert the Hurt Locker and Lanny from the DD, over and out.